who you all know, one of the instructors in our service, former member, present instructor. And we're going to be talking about the GPS, the Gann Positioning Satellite. Again, not trying to be facetious here. I just thought that was a funny title. It's definitely going to show you how we, and Mike specifically, uses these Gann levels as a roadmap to the market and as a huge help to some of the stuff that he does personally. But before we begin, as always, this presentation is for information purposes only and does not constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading the foreign exchange, futures, and equity markets can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial conditions, and past performance, as always, is not indicative of future results. Mike and I wanted to do this in place of our normal gold webinar, which will soon be renamed The Insider with Mike Arnold. So we wanted to do something free and specifically something that Mike will be teaching in our new offering. Now, I just read that this is not intended for solicitation. There won't be a link to sign up. We're not going to be at the end of this saying, now join our service. That's not happening. We're just giving you guys an example of the type of things that we teach. If you decide to seek us out or you decide to join us in our new product, we'd love to have you. If not, we understand. Just take this and use it as best you can. So, who are we? I'm not going to read this, and I'm not going to go into who I am. The vast majority of you in here know who I am. But if you're interested in reading a little bit about my background, hit pause on the recording that we'll distribute later and just go ahead and read this. But I'd like to give Mike a couple of minutes to kind of talk about his background for some of you that maybe missed the last webinar or haven't been a part of our service for a little while from the point on which Mike joined. So Mike, if you want to talk a little bit about your background, and then we'll get started on the actual content.
Hi guys, thanks for being here today. This is Mike. Just a quick little background for those who don't know who I am. I originally graduated with a degree in electrical engineering, so heavy in math and science. Started trading in '92. I went down first to the exchanges and got an internship where I worked for free for 6 months to learn stuff. I was trained as an options market maker. Since that time, I've traded in Chicago, New York, Switzerland. Went off the floor, went to off-floor things. I've programmed trading systems for funds. I've done trading system research and design for funds, risk management research for funds. More recently, I was a partner in a stat arb and pair trading training firm where we trained traders to do pair trading in stocks, and I've consulted a lot of hedge funds on quant strategies and risk management, which I already covered. So again, I've been doing this since '92, seen a lot of things, done a lot of things, traded a lot of different markets, and trying to just share some knowledge with all you guys. Thanks.
Mike's got about, I think we figured it was about 9 months more experience than me, Mike. I think it was somewhere in that, close to a year more experience than me.
Yep.
It's about 9 months, right?
It's not much more. We're pretty...
Yeah, pretty right on. I'm a little fired up today, guys. Is it weird that I love the song Getting Jiggy With It today? I don't know why I threw that out. It just might be weird to some of you. All right, what are we going to cover today? We're going to compare traditional Fibonacci levels to Gann levels, okay? The market really knows a lot about the Fibonacci levels, how to trade them, where they're supposed to go. It's our feeling that they're less useful than the Gann levels, just in a general sense, right? Just in a general sense. And the Gann levels are not as well known. We think they're simpler, and as it is with everything that we teach and everything that we profess and preach, we want to simplify rather than complicate. So you're going to learn the key Gann levels. We're going to teach you the basic price action that moves between the Gann levels, which is the thing that you'll be able to potentially add to your trading. You'll see how you can potentially use these levels in your current trading methodology. Now, in the Insider with Mike Arnold, which will start in a week or two, he's going to go into this stuff in a lot of detail. But right now, we're just going to show you where these fit in and how you can potentially use them. And I'm sure Mike will go into a little bit of what he uses, how he uses these from a macro level rather than from a micro level. So let's talk a little bit about them. You guys know that I do fundamental analysis on television. I trade technically only, but the background of this stuff is always interesting to me. Leonardo Bonacci, his name wasn't actually Bonacci. He was Leonardo Pisano, which technically translates into Leonardo of Pisa. He's from Pisa, Italy. He was born, I think, in 1192, or 1125, rather. And he's from the town with the Leaning Tower, interestingly enough. So he was known as Leonardo of Pisa, Leonardo Pisano, or Leonardo Bonacci, which would be what his name would be in the modern times. Mostly in his time, he was called Leonardo Felis Bonacci, or the son of Bonaccio. His father was also, by the way, a mathematician and a politician. He wrote his definitive work, Liber Abaci, in 1202. 1202. We're still looking at things in the markets that were written in 1202. Right? He was one of the first people to introduce the Hindu-Arabic number system into Europe, the positional system we use today based on 10 digits with a decimal point and a symbol for 0. Now, the reason he came to that conclusion is he studied something. He didn't invent this, okay? He didn't necessarily invent these figures. He endorsed a system after studying the 9 Indian figures, which are 9, 8, 7, 6, 5, 4, 3, 2, 1, and he concluded with these 9 figures and a sign up for the number 0, or a lack of a digit, any number can be written. And to him, it was very logical that if you should default to this particular numeric system, and we use it today, right? We use that today with with the numbers 1 through 9, and then a number for 0. Every number can be written, and obviously, in our decimal point system and in everyday math, we use tens. I mean, we even talked about at times that, even numbers in trading actually have a psychological effect on the markets. That's based on this Hindu-Arabic number system, or the 9 Indian figures. So he wrote a series of numbers out that are now named for him. Okay, now where did he get that series of numbers? Well, again, from studying the 9 Indian digits, but he explained it with something called the rabbit problem. On kind of a lighter note, he's also credited with inventing the word problem in math. You know, if Leo is going to Mary's house and he's taking a train that's going 60 miles an hour, how long will it take him to get there if she lives 3 hours away, that kind of thing. He's actually credited with inventing that, which is really not important. The rabbit problem was, he put this in his book, Liber Abaci, how many pairs of rabbits are created by 1 pair in a year? So the problem was, a certain man had 1 pair of rabbits together in a certain enclosed place, and one wishes to know how many are created from a pair in 1 year, when it is the nature of them in a single month to bear another pair. And in the second month, those pairs also bear another pair. So how many would you have at the end of the year? And he solved it by saying, because the above written pair in the first month bore, you will double it. There will be 2 pairs in 1 month. One of these, namely the first, bears in the second month, and thus there are in the second month 3 pairs. Of these, in 1 month, 2 are pregnant, and in the third month, 2 pairs of rabbits are born, and so on and so on. And concluded, to still be added to that 144 pair down at the bottom, there'll be 377 pairs in a year. Okay, and that really is what produced, or rather that's how he described the traditional Fibonacci numbers. All right, so you see 1 plus 1 equals 2. If you're following along here, you add 1 to 1, and that's 2. You add 2 to 1, and that's 3. You add 3 to 2, and that's 5. You add 5 to 3, and that's 8. You add 8 to 5, and that's 13, and so on out into infinity. Those are the Fibonacci numbers, all right? Dividing one number by the previous number gives the golden mean of 610. Divide that by 377, and you get 161.8. These are the commonly used retracements in the reciprocal of the golden mean. 1 and 1.618 equals 0.618. Anyone that's looked at Fibonacci knows about that 61.8 level, knows about that being the level where it is now extremely high probability, somewhere in the range of mid 80%, that a move is going to be retraced 100% once it is retraced 61.8%. Mike, do you want to comment on these numbers a bit?
So there's many other levels that many people have probably seen, that are derived from these same series, and a lot of people don't even know how they're derived. but a lot of people use the 0.236 retracement level, or 23.6%, which is dividing one number by 3 to the right. So pick a number, and the farther out you go, the more it converges on this 23.6. So if we were going to divide 89 by something, we go through to the right, which would be 144, 233, 337. So we divide 89 by 337, and we get this 0.236 level. If you were doing 144, you'd go through to the right and divide it by 610. That's another common number that you use. A lot of people use the 38.2% retracement, which is the square of 0.618. So it's 0.618 times 0.618, and that's how you get the 0.382 number. The 0.5 numbers thrown in there, I mean, we've all seen that in markets, the halfway retracement. A lot of people use entries on halfway retracements or targets of halfway retracements of longer moves, and that's just the first, really the first two numbers in the sequence that are non-repeating. So 1-1 is repeating, which just gives you 1, but 1-2 is the first non-repeating sequence, which gives you 0.5. Then some people use the 0.786 number, and that is the square root of 0.618. Or if you're an engineer or a mathematician, you can, instead of drawing a square root sign, you can also do to the power of 1/2, which is the square root of that number. So that's how it's put on the slide. So the 78.6 retracement level comes from the square root of 0.618. So when you translate all these into the Fibonacci percents, you just multiply them by 100, get a percentage level, and that's what a lot of people draw on their charts.
So it's interesting because a lot of people don't realize why they're using these numbers. They just use them because it's in their MetaTrader or it's in whatever platform they're using. But I always think that the background of these things are really interesting. And the background of William Dilbert Gann, that's right, Dilbert, he was basically a finance trader who developed the technical analysis tools known as the Gann angles. That's what most people know him from. Most people will look at Gann angles, Gann fans. They're not as familiar with the Gann levels, though. The Gann angles consist of the square of 9, the hexagon, and the circle of 360. His methods are based on geometry, astronomy and astrology, and ancient mathematics, right? Fibonacci, ancient mathematics. He based a lot of his research on that, and he simplified and perfected a lot of those same levels. Gann was born on June 6, 1878 in Lufkin, Texas. His father was a cotton farmer. It's a bit of the way that he got involved in trading. So he was a commodities trader first. He started trading in 1902 when he was 24 years old. Now, his methods are simple and logical, but their uses are in dispute in trading. And this is what I mean. Gann is less understood and less used than Fibonacci. Okay, much less understood and much less used. And again, he was also in dispute as to whether he even made money trading over his life, although in an article with Ticker years later, which you can look up on the internet and read it, it was proven that he had made not only money, but a substantial amount of money over his career using his methods. And just to sort of illustrate how simple a lot of his methods are and a lot of his calculations were, the most important angle to him is the 45-degree angle, or the 1-by-1. I mean, that seems pretty obvious and simple if you're sitting there looking at a chart, that the most important or pivotal angle would be the 45-degree angle, right, in between the 90s. But what does it mean from a market perspective? Well, really all it is it's a concept of a move of 1 unit of price for 1 unit of time. Whatever that unit of price is and whatever that unit of time is, regardless, if you went 1 for 1, you would have a 45-degree angle. So it's sort of the fulcrum and the crux for all of the Gann fans and all of the Gann angles. You draw a perfect square, then you draw a diagonal line from one corner of the square to the other. You've illustrated the concept of the 1-by-1 angle, which moves up 1 point per day. I'm going to go ahead and give the screen over to Mike and let him go a little bit more into the Ganns, and this is really his specialty here.
Can you just go back a screen, Bob, real quick? So, I mean, a lot of people who've looked at Gann angles, this is the classic 1-by-1, and there's 1-by-2s, 1-by-3s, 3-by-1s, a 2-by-1. You know, it's just different interactions of price and time. And a lot of people, and this stuff gets very sort of complex, and it's really dependent. I've played with it a lot in the past, but it's really dependent on where you draw points. It gets really esoteric. It's in some ways, it's sort of like, you know, anybody who's studied Elliott wave, you can give the same chart to like 5 different people, and they're all going to come up with a different sort of set of lines on the chart. And that's something I've somewhat found with Gann over time, that there are certain Gann masters, just as there are some Elliott wave masters, but you give it to some people and they come up with completely different solution sets. So I just wanted to comment on that real quick. Let's see. I can't, okay, there we go. So we're just going over some basic Gann levels, and we're even taking time out of the equation for this. There is no time in this, but this is Gann's rule of 8, and Gann was really infatuated with circles and pi, and not to go into that too much, but this is where this started to derive from. And he divided a circle into 8 equal parts, and if you divide a circle and look at the way it's divided, it comes up with these decimals. You get 1/8, 2/8, 3/8, 4/8, 5/8, 6/8, 7/8, and if you do all the math, you can see it on the screen. You know, 0.125, 0.375, 0.5, 0.625, 0.75, and 0.875. And again, you can change those into percentages, like 12.5%, 25%, 37.5%. And already what you should start to be seeing is the similarity between some of the Gann levels and some of the Fibonacci levels. So if we go ahead and we look ahead of comparing Fib to Gann, let's look how these levels compare. So we take a Gann level of 12.5%. Well, I don't know of a commonly used Fib level. Maybe there's an esoteric Fib level that I don't know about, but I don't have a commonly used one that if you go to a lot of Fib traders, they have up on all their charts. So I'm just going to leave that on the question mark. A 25% Gann level is relatively close to the 23.6 Fib level. And again, you know, the 23.6 Fib levels taken by dividing one number and jumping 3 forward, which somewhat gets very esoteric in the Fib world even, but a lot of people were looking for some kind of number because they noticed price action around there that would occur. So again, the Gann level of 25 maps to that. The Gann level about 37.5 maps to the commonly used 38.2 level. They're very similar levels. 0.5 or 50% is 50% in both of them. You divide a circle in half, half is 50%, the other half is 50%, just like 1 divided by 2 in the Fibonacci sequence is 50%. The 62.5% Gann level is very, very, very close to the 61.8 level, which was just the reciprocal of the 1.618 Fib level. The 75% Gann level is somewhat close to 78.6 level. Other people, there's another Fib level that some people use. I think it's 76.4, which is even closer, but that one's even more esoteric. I don't even remember how that one's derived off the top of my head. So right now I'm just putting on this. These are about the similar levels. And then there's an 87.5% Gann level, which I don't know of a commonly used Fib level at all that people use around that range. So you can somewhat see how there's going to be overlap. And again, with Fib levels even, they're not hard and fast numbers. We don't, if we're looking, let's say we're looking for a 61.8% retracement. Most people, I know some sticklers who calculate it down to a pip or a tick or a penny if they're trading stocks. Most people treat it as zones or areas. They're looking for something to occur in that area, and it's the same with the Gann levels. We're not talking that you're going to take a like 5-week move, drop Fib levels or Gann levels, and things are going to stop to the exact pip on a Forex chart at that level. We're looking for things to happen at those levels. So just if you're using fib levels now, I don't know a lot of people who use the Gann levels, but let's just say we're using fib levels now. One question I ask traders is how they use fib levels. And some people, do you watch for reversals? If so, at which level? And some people say, well, I watch to see if something happens at that level. Well, what specifically are you watching to happen? Well, I'm watching for a reversal, or I'm watching for, and it's mainly they answer with reversals. Or they just say, I just have them on my charts because a lot of people watch them, and sometimes I see things happen at those levels. But do they watch for continuation moves? If so, where? Do you watch from a continuation move from, like, if one level's broken, where's it going? Is it going to the next level? And those even get more esoteric. I don't know as many people who look at continuation moves with fib levels. Do you use them as stop-loss points? If so, which levels and how do you use them? Would you use them as let's say you get in at the 38.2 level. Are you looking at to go to the 0.5 level before it reverses? These are questions that a lot of people, they don't really have good answers for this on these kind of levels. So, and they haven't really incorporated them really solidly into their trading system. So now, let's just take a visual comparison and looking at the levels, and there's no price action on these, and the areas without a yellow line is pretty much where there is no equivalent fib level. So at the 12.5% mark, there's no equivalent fib level, so there's no yellow line. We have a reversal zone. If you're putting both these up on your chart, you could have like the 23.6 to the 25 area maybe as a zone. This would be the 37.5 to 38.2, which is a very narrow zone. The 50 zone, it's equal, so there's not really a yellow line there. 61.8 to 62.5, very narrow zone. This is a wider zone, the 75 to 78.6 zone, and then there's no real corresponding level at this 87.5. So you can see that if you're using one or the other, you're going to be in the same ballpark area looking for potential moves. So if we put these levels on a chart, and we're using a chart, I think this was just a Euro US dollar chart, and it's taking a key low and a key high. As we unfold the chart, you'll see. And these lines, they're not useful yet because we're not looking at them while the move's continuing, but we're assuming that a key high has been made. So we're going to see where we retrace and how these levels match up and what price action does around these levels. So if we now move forward, here's the key low and key high. Let's look what happens. So we immediately go through this 12.5 level. Don't even pause at the 23.6. We get some kind of pause. You know, we get a stop right here on this red candle real close to the level. The next one tests the level. Then we break through, rally up, go through to 37.5, don't quite get done to the 0.5 level. Then it rallies all the way back up. We somewhat pause at the 25 level going the other way and at the 23.6 level. Then we travel right up and really halt at this 12.5 level. And you can sort of see how it's going back and forth eventually between these levels. And somewhat how it comes into play. We go down and we test the 0.5 level. We go back to 0.375 or to 38.2 level. Then we go back to the 23.6 level. And again, these are why they're zones. Sometimes they stop pretty dead on, but there's also noise around them. And for the people who might have seen some stuff on candlestick math, if you look at some of the candlestick math at this level, like these two railroad tracks, forms a nice tail bar right at 12.5 level. These two railroad tracks, yeah, we shoot through it. We stop right at the level, then we shoot through it, but we get a major reversal. Then it comes down, and we have railroad tracks around these levels. That turns into, if you add them together, it turns into a nice tail bar. And you can somewhat see how things occur near these levels. Now, is that useful? That's what you have to decide for your trading. But you can see how it travels down back and forth through these levels repeatedly. So let's investigate this a little further and a little closer. So now taking the fib levels off, I've done a lot of research, and actually with a couple funds into this, and this is how there have been trading systems just developed in this sort of way by itself, but this is very simplified of how we can look at it on the chart. So when you have a key level broken, our target is the next level area. Again, it's not stopping to the pip. It could sometimes stop to the pip or the tick or the penny, but generally it's a target area. So if we have this 12.5 level broken, our target would be the 25 area. If we have the 25 level broken, the next target is going to be the 37.5 level area. If we have the 37.5, you know, it's down to 0.5, and we keep going, the 0.5 to the 62.5. If we go back up the other way now, if we go back above the 0.5 or the 50% level, our next target is the 37.5 area. Now, how can this be useful for trading? Okay, so now here we have this is an Aussie US dollar daily chart. So we have a key swing low and a key swing high. So again, and it's in congestion up here around this, and we come down, we break the 12.5 level. Now, if I was watching at this, the moment I saw that happen, I'd be watching for a test of this 25% level. A test of the 25% level. So now I'm going to watch. And this is not, we're not treating these like a trend line break. We're not treating these for the people who know the core strategy like, okay, we closed on the other side of a significant level. You know, these are, again, our areas. We're not just, oh, we closed below the 25 level. We have to immediately go down. No, this is a daily chart. I would be going to shorter term charts. If I was just looking at level trades, I would be dropping down to the 4-hour or the 1-hour or possibly the 15-minute to see what the price action was. Well, we don't quite get back up to the next level. We break down through the 25 level, and we target the 37.5. We come back up, hit this level, and candlestick math, you actually get a really nice tail. We come back down to this level. We come back up, stop dead at the level. Now, see, it can occasionally happen, or that could just be a fluke. It could just be, hey, it just happened to stop there. But then we go down to the next level. So I'm watching these to the levels. Well, you can say, well, it doesn't stop. How could I really use this? Well, most of the time, I just don't use these levels and targets and everything alone. I use them in conjunction with another system or strategy because it now gives me a roadmap. It gives me things to target. It gives me stop areas. And when I call up the next chart, you'll start to see how I can layer things together. And the reason I'm putting this out there right now is because I don't care what you trade. You might want to start looking at this, and maybe if it's helpful for your system, or maybe if there's these levels or these targets or these rotations can help you. And similar to the candlestick math that I did with Bob, where one of the goals was showing you how there's so much noise, and there's to help you stay with the trade, that if you compress candlesticks down, it really showed you that it wasn't that big a deal. It was just, hey, these 12 candlesticks collapsed into a doji. Well, if you look at this, let's just say your trading system said, okay, we're getting short at a break of this congestion, and I'm going to target down at the 0.5 retracement level of this big thing. Well, a lot of people, they think, hey, it's going to get there. It's just going to collapse. You know what? It's going to have to get to that 0.5 level. I don't want to wait very long. Well, this is a daily chart. One of the things at the Gann levels, and I've shown this to people, and they start seeing, okay, I'm looking for all these. It could stop at or near very one of these zones and rotate back up to the previous zone in these 12.5% increments. And they start seeing how these rotations are natural parts of the market, and they don't need to panic on every rotation. Oh, it's coming up to hit my stop. Oh, it's going back down. Oh, it's coming up to hit my stop. Oh, it's going back down. Oh, this is taking too long. These are the natural waves of the market. So that's one of the ways that I found it can also be helpful to people, even if they're not using the levels to trade. They can see how there could be areas so that should they panic every time it rotates. Oh, it stopped at the 37.5. Well, if it stopped there, where could it go back to? It could easily go back to the 25% level before it resumes its downward trend, if it's going to resume its downward trend.
And it's one of those things, if I could, Mike, it's if I could, it's one of those things that Brink just threw in there seems to be a rough relationship between Gann fib levels and significant levels. When we teach significant levels and how to find them, right, we don't blend in Ganns or fibs as part of discovering them because we want the price action. Price action in trading isn't always technical. Okay, there's reasons behind the scenes that you or I can't know as to why a particular price matters. There may be some sort of massive swap that includes huge positions in the Aussie US dollar, and a particular level, especially in a low volume time or a less active period in the market, levels can be defended to protect and I'm talking really large, okay, like Goldman Sachs, George Soros type large. And we don't know why a market will stop at a level, but we want to notice it. But in terms of rough correlations between the two, it's not that they're correlated, it's just that a lot of the times traders will look at these levels, and what Mike just said is extremely important. When you're looking at a trade that you're already in, Mike's not saying to you, okay, now use this as a stop, use this as a target. He's saying use this to help sort of layer in the psychology that's needed to figure out why you're in a particular trade, why you're staying in a particular trade, and why this last particular move doesn't scare you, okay? Nor should it, because again, the whole point of what we're trying to explain to people, what we're trying to get people to understand, we're trying to get you to understand trading, not strategies. And these Gann levels are a very good way of seeing why moves will happen. But you know what? It didn't really go through a significant area. It didn't really go through a Gann level. It's moving because markets move. It's not moving because it's moving against me or it's moving for me. Okay, our priority is to put on the proper trades, not to have it go straight to our target so that our mind is comfortable with it. Go ahead, Mike.
Very good points. Very good points. So let's just now take a look at how I will roll this in with a systematic approach that I use more. Now this is the same. This is sort of zoomed in, but I have a couple of the key moving averages we use, which, funny enough, are derived from the Fibonacci levels. But now I'm watching, and these are we've touched on this, where we're watching for potential reversal or rotation trades in the areas between these two moving averages. So the reversal trades are highlighted here. But if I'm looking at this, okay, we get a nice rotation into these moving averages. We break down through the level. Where do I naturally think my next area where I could find support? It's going to be down here around the 37.5. And yes, it went through. And I could have sat and looked through and found, oh, look, it stopped right at this level and it went to the next level. That wasn't the point of this. I don't want perfection in this. I want to help me gauge to where I can be trading this. So if this was on a daily chart, maybe I entered this rotation trade on a 4-hour or a 1-hour chart. Am I going to think it's going all the way south to like 500 pips down before we get any other rotations? No. I'm going to be watching, and if I'm trailing out, or maybe I'm still trading on a 1-hour chart or something, and I start seeing support coming in and seeing tails, and remember, these are daily bars, so we could have been in this trade for 3 days, or if you exited partial of the 4-day or you trailed out here, well, it was natural to trail out there, and so we get support here. Now I'm looking for it to go back up to the other zone, which also overlaps very closely with returning to the prior level. So I'm looking for some kind of reversal in here, and again, on a daily chart, it's very obvious, and you wouldn't have necessarily traded this on a daily chart because you would have missed a lot of the move. But on a 4-hour or 1-hour entry that you look for in this zone, hey, we look for it to go back down to the prior level. It went through it. It came back up into the zone. We broke down that. We broke down this 37.5 level. Now I'm really watching it to go to the 0.5 level. And we come down, we tackle this 0.5 level. We get a double test this 0.5 level, and then we rock it back to the 0.375 level, but it also completely goes out of our zone, so I'm not looking for any more of those trades in the zone anymore. If we get above this level, then I'll be looking for it to go back to the 25 level. That's just the way I'm thinking. Now there might be some other setup, there might be something else. It doesn't mean I'm looking now to take a long trade. It just means that now I have this information. It's a roadmap. It's the Gann positioning system. It's helping me navigate the markets a little more. Now, to further put that in, since I know things travel between the levels, let's get to the next slide here. So if I'm trading in this area, okay, where's my stop? Because I know it can transition to different levels. I'm looking that if I'm getting in a shorter term rotation and my target's all the way down here, really if I should be fairly safe getting my stop above this level. And as I talk about in the room all the time, I want to get my stops above as many key things as possible. So there might be a significant level here. I already know my stop would be above this moving average, and I'd like to get it up, hey, if I can. Great, I got it also above this Gann level because we shouldn't rotate back up to that level. Because if we break through and break this down through this key daily low, I'm targeting this next level. So now I have another way that I can incorporate this for my stop placement. We get the rotation in here. Well, I don't need my stop all the way above this level, but if I get it somewhere above this level, which is also above the blue moving average, and we get the rotation, well, now I'm tackling back down to at least this level, if not beyond it, because we already violated it before by a bit. If I come back and rotate in this level, now, there's another little thing that we've done a lot of studies on, and yes, you could put your stop back up above this 25% level, but a lot of times, especially if it breaks down really close to the bottom quarter of this level, you can just get your stop somewhere above the halfway point in the level, which would put it above the blue line, above this, and we might have a significant level in here also, which would give us, or maybe multiple levels in here, that would give us multiple things in the way where price generally would stop. So it would be, you know what, if the price does come up above this level, we'll get stopped out, but we had we had a lot of things in the way that will sort of be roadblocks to getting stopped out. And then we also know our target down there. So this is how they can be layered in. And somebody might have a completely different system, but this could help them. They could be doing retracements, and they could be looking at some oscillator. Now we're retracing. Oh, we're oversold, and I'm downtrending, so I'm going to be looking to sell an oversold level, and I'm going to be looking to maybe target the next lower level. And then I can put my stop, because a lot of people just trading oscillator systems sometimes don't have the best stop levels, but this can provide them with, hey, areas to place my stop above because of the rotation aspect of the levels. So that's just one way you might want to consider, no matter what you're trading, and investigate something like this and see if it can help your trading with not only potential targets but also where to place your stops. So here's some notes also, and again, this is just a very high-level summary, but key things that I've discovered over time and just want to share with you. It might save you a lot of time and research. So in stocks and futures, most major reversals tend to occur between the 50% and the 62.5% level. A lot of pullbacks, you'll draw longer-term levels, and that would be similar to reversals happening at either at the 50 or the 61.8 in the fib levels. In the Forex market, many reversals go beyond the 62.5 level, and they go to the 75% level, which really, and that's something a lot of people stop watching fib retracements. Once something gets beyond like the 61.8 level, they just say, okay, this thing's probably retracing the full move back. Well, one of the things you might want to watch for is if you get to the 75 level, and the 75 level does hold up a lot better than the 78.3 level if you're just a pure fib trader, so you might want to watch closer to the 75 level. But if you're starting to see major reversal patterns, major topping patterns, or something else at a 75% level, that's something you probably want to research and maybe incorporate it in your trading if that will work for you in your trading plan. Breakouts from congestion, or key breakout levels. Many times a currency of Forex will pull back to between the 12.5% level and 25% level. And this is where I really love the 12.5% level. And this is why I really like the division of 8 levels also all the way up and down, because it gives me a little stronger roadmap than just using maybe 3 or 4 fib levels. It really can round out the trading. So I will watch a lot of times for, all right, we're breaking out and we'll get a quick pullback to a 12.5 to a 25 level retracement. So I'll highlight that on a chart and watch for a rotation back to that level. When a key moving average or other support resistance line up again levels, expect a stronger reaction. I just found that. You know, when things line up, when I'm looking for a rotation in a level, and it's a Gann level, it could be the fib level or the Gann level, and we have a key moving average there, and we have a significant level there, or for some people, a major support resistance line, or maybe a trend line. It's an even stronger level. Generally, because people are getting in, and for some reason, these levels, whether you go by the fib thing of it's a natural unfolding of growth, like the sunflower circles and the tree rings and the rabbits, or if you go, there's something with pi and it's divided by 8, and we get these reactions in these 12.5% increments. It doesn't really matter. Seems to be either way, you get some natural rhythms in the market, and when it also lines up with other things, it really reinforces a natural rhythm. So here's just an example of a breakout and return to 12.5. So we have a key low, and this is just down to a 1-hour chart. I actually was looking at this on a higher time frame chart, like a 4-hour chart, but we broke out of this key. This was on actually a bigger pattern. There was a double bottom pattern here that was broken out of with, okay, targets way up here for a double bot off the chart. But we broke out of a key level. So immediately I was looking for drawing it from this key low to this key high where we paused right before the breakout, looking for a rotation back. And this buy zone is highlighted between the 12 and the 25. I also have rising key moving averages coming in here. So we dip into this level, we pause, we have key moving averages coming up, and we rotate out. So this gave, whether you waited for the move, started to move back up to get in, whether you started to see getting support in this zone, whether it also returned to the breakout level. So we have multiple things lining up in the key level. So this is where, hey, I got confluence of multiple things. We're between a zone that holds up a lot of time, a Gann zone that holds back for immediately return to. So that's where I was watching for a rotation entry.
Let me just touch, Mike, if I could, let me just touch on something from a perspective of confluence, because
sure,
that word is used a lot, and in my opinion, it's overused. What Mike is saying here is that he has a buy signal, period. Now, what is he looking for? He's looking for the best possible entry for his particular style of trading. So when he talks about a confluence of things, there's a confluence of things within a strategy telling him to buy somewhere in that yellow buy zone. Okay, it's not that there's more things telling him that his trade is going to work. So that, I think anytime we use the word confluence, whether you're a student, teacher, just a trader, just somebody listening in, when you use the word confluence, understand the difference between a confluence of strategies telling you to go long or a confluence of things telling you where to go long in this particular example. The second is the one that the responsible trader uses. When you're looking for the best possible entry for a signal that your particular system gave you, or the systems that we teach gave you, you want to be able to find your optimum entry, but you don't want to look for a bunch of other systems to chime in and agree with your particular long situation.
No, that's an excellent point, and that really need to be said, because it's not like, oh, because all these things are happening in this area, it's going to be a higher probability trade even. The probabilities on this trade are the probabilities on this trade. All I'm looking at is, okay, I'm looking for a good entry. So I know we get in this zone a lot. I know we're coming to a zone of moving averages. I know a lot of just classical technical analysis. You break out from a key level, you return to the breakout level. I'm putting that together, and look, this trade could be a loser. It doesn't matter. Just because all these things lined up does not mean the trade is more likely to work out. It means I found an area where I'm looking to enter that gives me a good price point entry. So now I still have to do my risk reward, and I still have to manage the trade. You know, and I'm not putting on more risk because we had this things all happen in the buy zone. I'm putting on my standard risk. I'm using this information to get a good price point entry that I'm happy with. I put on the trade with my proper risk reward, and then I let the trade go. So now on the next slide, let's see. Come on. Just trying to get it to advance. Sorry about that, guys. On the next slide, this is just a quick little thing of what a lot of people will stop looking at, and this is an example of the 75% level. So again, this might, I mean, I'm not saying you're going to trade this reversal at the 75% level, but this is something I will notice because a lot of people we have been, and the 61.8 level is going to be right about here, or the 62.5 level, and a lot of people think, hey, that level's broken. So many people place stops, especially, again, this is a daily chart on the other side of this level, that they think, okay, the move's going to come back up. There's a major potential reversal zone. Hey, we're stalling out. I'm going to short this move. I'm going to get short here. Then my stop's going to go above the 61.8 level or the 62.5 level. And in Forex, this seems to happen a lot. It'll pop through there. A lot of people get taken out, and then we'll get some kind of reversal at the 75 level. So I'm just showing you this as an example. This is something I watch for. I just won't trade off these levels blindly, but I will watch for something, and you know, it fits into my shorter-term trading plan, and I have ways I trade this thing, so it's a useful tool for me. If it's useful for you, then that's fantastic. So let's just go through a quick summary. The Gann levels can help you determine realistic targets and help with stop placement. Just like Fibonacci levels, Gann levels are areas. If you want to try to figure out something and use it down to a tick level or a pip level, then that's fine. I use them as areas, and I use them to help me to see the unfolding pattern in the market, sort of as a roadmap. They can help you stay in trades by realizing the waves of the market are natural, meaning just because you're getting rotations on your way, you may have a trade that's 150 pips away for a target. Now, yes, there are certain times it could collapse. It could happen in 1 hour or 4 hours. We could get a huge major move, but that's not generally what happens. It normally goes through these rotation cycles. So having these levels up on my chart, realize, okay, we've hit the 37.5 level. We could easily rotate back to the 25 level before we continue down to the 0.5 level. That's just natural. It's a psychology tool that can be used to help you not panic out, to be comfortable with your trade, to let the trade just unfold and let the waves and the natural 12.5% rotations come into play, and let the trade either stop you out if it hits your initial stop or a trailing stop, or take you all the way to your target. But either way, there's going to be rotations in most of these trades, and there's going to be the movement between the levels. They can help longer-term traders gradually move stops as the trade unfolds. This might be something if you want to look at, especially longer term, you're trading off of, maybe you're going for swing moves off of 4-hour charts or daily charts, and you need another way to trail out, or you need another way out. I don't want to crowd my trade too much, but I want to keep it above key levels and see if I can, ride the trade longer and just trail it down as it goes through these rotations. This is something you might want to investigate to see if this can fit into your trading plan. And finally, they're best used on longer-term charts and larger moves. What I mean by that is, yes, I'll draw them down to sometimes 1-hour charts like I had on that example where, but it was a pretty big move on a 1-hour chart. I went from a major key low all the way up to a major key high and then watch for the 12 to 25% pullback. I'm not drawing these down on 15-minute charts, and most of the time I only draw them on daily and 4 hours. And then I drop down in time frame and look for the lower time frames to happen. Again, like anything else, the daily charts are going to overrule your 4-hour charts, are going to overrule your 1-hour charts. So if you get down and start drawing these on 15-minute, 5-minute charts and go, well, it's not showing me anything. No, it's probably not going to show you anything. It's for the larger moves on the longer-term charts. That's where I'd start investigating this, is if this is an area you want to go down. Do you have anything to add, Bob?
Yeah, I do. Real quick, I just want to tell you that we have somebody in here whose name is Fatty Fatso, which I love. But he says that there's fib traders that use the 89% and the 11. My guess is that that's probably, I've heard of the 89. I've never heard of the 11, but it's probably something that's just an adaptive fib method. So I wanted to make sure I got that out there. The second thing was, Toby wants to know what's the best way to get the fib levels on the MetaTrader. Did you just add them manually to your retracement?
Yeah, I just add the levels. You can go through your fib tool and just add whatever levels you want, and then I set them as my default, so anytime I draw those lines, they just appear on the chart. And you know, it also, that's a point. If you want to add in maybe a couple of the Gann levels, maybe you want to start looking at the 12.5 and 87.5, but keep your other levels just because you're used to using them, the fib levels, that's all fine too. And they're so close to each other, and we're not talking stops and fibs. So you might want to mix and match things, but it is pretty easy on MetaTrader to just add them all into your fib tool.
Now, Frank wants to see if we can do a live example, but Frank, I'm going to say no to that for a number of reasons. In our service, we had a potential long recommendation in the dollar Canada that may trigger in a few minutes, and Frank wanted to put the Gann levels on there, but we can't do that, Frank, because we've got people in here who don't know the core strategy, not really members of the service, and it'll just be confusing, because next thing you know, we'll be putting Gann levels up on a trade, and we'll get a flow of questions as to how did you get that trade, where's your stop going to be, position sizing. It's too much. What we're doing in this particular webinar is showing you another input. For example, let's say that we give out a recommendation, or your signal gives out a recommendation, or something like that. Let's say that the target area you've chosen, the top of an area of space, or a specific rotation, or a target on a double top or a double bottom, the mathematical target, and you see that the 75% fib, or I'm sorry, Gann level comes in within 8 or 10 pips below your target. You might want to consider, if the risk is still good, looking at that. We use target areas when we recommend trades. So if you have something that's as powerful as these Gann levels that Mike just showed you, that's where you're going to want to look at it. Another thing is, if, let's say that you have a stop level, let's just throw out a level. Let's say it's 99.46. Doesn't even matter what pair it is. And you have a Gann level at 99.49. All right, you might want to creep it a little bit above the Gann level, and if you decide that you can't get it above a Gann level that's so close, you may want to move on. You know, we use this cliche all the time that there's 3 possible outcomes to a trade, win, a loss, and a break even, and 2 of them are good, obviously being the win and the break even. You may just want to move on it, pass on a trade simply because you're uncomfortable where the Gann levels are. That's something that over time is going to help you in your living document, which is your trading plan. Right? Your trading plan is a living document. And if you find yourself being affected by these levels, and you're starting to move into that state of unconscious competence, write it into your trading plan and do it all the time. Frank says, fib levels is that there are various, wait a minute, hang on, I got to get to the beginning. Let me get to the beginning of that question, Frank, and then I'll ask it. The question was, the issue I find confusing about fib levels, there are various places to place the start and the end of the moves in the fib levels. Usually it's significant highs and lows, but these levels can be somewhat interpretive. It really depends on what you're doing as to where you place your retracement fib levels. Okay, and what I mean by that is, those of you that are members of the service, you know the inputs to our long-term trend strategy. We have a specific place to put the Fibonacci's for the trailing stop. Okay, but in general, just in general, all right, you're going to want to place the ultimate swing high to ultimate swing low, or vice versa. Okay, it's going to want to be a period of time, a specific move. When you're looking at a chart, you can see what the specific move is. Is it subjective? It's subjective for the different strategies. People have different ways of retracing moves. The thing about the Fibonacci levels and the Gann levels seem to flow as well. Fibonacci's reason for using the rabbit example is he wanted to give examples that these levels exist in nature. Okay, if you can have certain specific inputs, those levels will naturally occur. So you can take one long candle, all right, one long 50, 100 pip candle and retrace it, and the retracement levels will have some sort of reaction. The Gann levels will as well. So that's why Gann is even more confusing to people in general, because Gann is lesser known than Fibonacci, but yet brings about some of the same interpretive problems. That's what Mike is trying to show you. Okay, he's trying to show you that there's ways that you can experiment and use these particular levels, and his research has found them to be more effective, more reflective, and more reactionary than some of the Fibonacci levels have been. Am I wrong about that, Mike?
Spot on. I mean, I completely stopped once. We ran a lot of research, and we, again, since these are zones, when you do your research, you can't just say what percentage of moves stopped exactly with this pip at the 23.6 versus 25. But what we found was the noise around the reversals around the 25 level were much more they were much more predictive than the reversals around the 23.6. And a lot of reversals happen just in front of the 25 level. So that's why I have incorporated into, I don't use the 23.6, I use the 25, just because it tested out better, and it kept me where I was trailing with or had to stop above or below a key 25 level, it would keep me in more trades. So that's how I incorporated it in my plan. But again, these are levels, and whatever you're doing, I'm introducing this because the natural rhythm of these moves, or these circular rotational moves as they unfold, and just watching them, you'll start to see things, and then you can do your own research into it and see how that could maybe affect the way where your stops go or where your targets go, or maybe it won't. Maybe it was just, hey, that was nice to learn about, and I can move on now.
That's a key point. Okay, this is a tool. We have not just given out a strategy. We've given out a very helpful and well-researched, Mike, thanks by the way, well-researched tool to improve the trading that you're already doing. Okay, that's really the goal of this little particular piece of information. These Gann levels, they're not widely used or widely known. Fibonacci is. So a lot of the times these self-fulfilling prophecies and things like Fibonacci's, when they get overused, they become less effective. John Dennis is saying, don't forget, John, it's really good to see you again, talk to you again, by the way. And don't forget that you can add dollars or percentage dollar sign to the add fib level. That goes to Toby's question. So for those of you that are members, if the vast majority of you forgot how to add levels on, we'll show you in the coming webinars. And remember, Mike uses these a lot in his daily trading, and when he starts the Insider, which again should start in about a week or two, he'll do a lot of specifics in the Insider. Okay, this is meant to be informative and to give you guys an idea of how these levels can improve the trading that you already do. Okay, if you're part of our service already, you'll get a lot more on this on a day-to-day basis, because when the new product is released, we'll be talking a lot about these Gann angles and about a lot of other improvements. We made improvements to existing strategies as opposed to coming out with a brand new foolproof, oh my God, that other strategy was foolproof, but now this one is even more foolproof. We don't do that. Okay, we have ongoing research on the strategies that we have found to be valuable already. So looks like there's no more questions, guys. Thanks for being here. Mike, again, thanks for sharing your knowledge. It's gracious of you to do so. And this recording will get sent out to everybody, and then for members of Trader Outlook, it'll be up in the media appearances tab as well. Guys, thanks for being here. Mike, thanks again.
Thanks, guys.